Rate cuts are here, and REITs are beginning to show why their time has come and how that can translate into some very nice returns. Hold on to your seatbelts, folks. This is going to be a good one. Real estate investment trusts, or just REITs, are investment vehicles that allow individuals to invest in a diversified portfolio of real estate assets without directly owning the properties. In a nutshell, they are companies that pool all those investment dollars from us to purchase, manage, and operate income-producing real estate, such as commercial buildings, shopping centers, apartments, and of course industrial properties. REITs generate revenue primarily through rental income and property appreciation. They are then required by law to pay out their taxable income to their shareholders, who will, of course, pay the taxes on this income for them. This, of course, is one of the reasons you should try to hold your REITs in a registered account like your TFSA or RRSP, so you're not paying those taxes. There is a really distinct relationship between REITs and the current interest rates, because interest rates influencing borrowing costs, and that, of course, affects investor demand. When interest rates rise, REITs usually face higher borrowing costs, which can reduce their profitability since they rely on debt to finance property acquisitions and, of course, development. High rates will hurt a REIT's bottom line. And to add insult to injury, that can make them much less attractive to investors who will begin to shift away from them. We actually saw that big time as we went into one of the most aggressive rate hike cycles in history. When interest rates go down like they are now, borrowing becomes cheaper, and this improves their profitability, thus making their dividend yields more attractive, which can then drive up demand for REITs and increase their market value. Speaking of REITs and going up, a sub to the channel can take us to the next floor. For this list, I was mostly looking at REITs, though I did include one REIT-adjacent stock that will follow along for the recovery I'm expecting to see in this sector. I did not add a lot of qualifiers, other than I was looking at least a $5 share value, and I think that only maybe eliminated one REIT from contention. Today's list is sorted, as usual, by their year-to-date total return, so without any further ado, let's do this. Kicking off this list, we have Extendicare with a ticker of EXE. They are based out of Markham, Ontario, and they provide care and services to seniors across Canada. They operate long-term care facilities, retirement communities, as well as home health care services. At the time of recording, their price was coming in at $15.25. They have a market cap of $683.60 million. Their beta, 1.26, and earnings per share come in at 0.68. Seeing that we are looking at REITs, we will look at their funds from operations instead of their price to earnings ratio, as it provides a more accurate measure with REITs. That funds from operation, that comes in at 27 cents per share. They've got a return on equity of a nice looking 60%. That return on assets, 8.57%. Their debt to equity ratio, that's coming in high, 305.80%. Of course, they are REITs. REITs do take on debt to finance buying new properties and all of that fun stuff, so they're gonna have higher than normal debt to equity ratios, and that's perfectly fine. Looking at their yield, that comes in at 5.861%. It's a monthly dividend of 4 cents per share. The payout ratio on that is 70.59%. Looking at their returns, on their 3-year return on investment, that comes in at 1.11%. Total return after we factor in the dividends, 18.89%. For the most part, the 3 years we're looking at today, they should be on the low side. Switching over to their 1-year return on investment, that's coming in at 23.16%. Sprinkle in some dividends, we get a total return of 30.38%. This year, year-to-date return on investment, 16.83%. Total return after we add in the dividends, 21.97%. Extendicare is without a doubt one of the key players in the senior care sector, and with more and more boomers moving into their golden years, the demand for their offerings are only going to go up. Coming in at number 4, we have the only non-REIT in the list with Timbercreek Financial. They have a ticker of TF, and they are based out of Toronto. They focus on originating and managing a diversified portfolio of high-quality, short-duration mortgage loans secured by income-producing real estate. At the time of recording, their price comes in at $7.90. They've got a market cap of $655.78 million. Their beta, it's sitting at 1.23, and they have earnings per share of 0.73. As I mentioned before, Timbercreek is not an official REIT. It is actually classified as a mortgage investment corporation or an MIC. As such, we will use the PE ratio for this one. I think it's the only one in the list that we're going to use the PE ratio for. And that PE ratio, I said PE ratio way too many times, that comes in at 10.20. Their return on equity comes in at 8.73%, and their return on assets come in at 3.50%. Their debt to equity ratio, that's coming in at 132.31%. Switching over to dividends, they have a yield of 8.734%. It's a monthly dividend of 5.8 cents per share. Payout ratio on that, 94.52%. On their 3-year return on investment, it comes in at negative 19.06%. Factor in the dividends, we do get a total return of 2.25%. So the dividends do save them on this horrible fall that they've experienced. But that's what happens when we had all of that aggressive rate hiking. It definitely tanked them big time, so we're looking for them to make that back up. Looking at that 1-year return on investment, we can see it's already begun with their 7.92%. Total return after we added in dividends, 17.43%. Switching to this year, year to date, that return on investment is coming in at 19.34%. Sprinkle in some dividends, and we get a total return of 26.34%. Where they do sit adjacent to a traditional REIT, they will ride the recovery with them. And for income-focused investors looking for an alternative to traditional REITs, Timbercreek Financial offers a unique opportunity with a relatively stable yield. Taking our third spot, we have Chartwell Retirement Residence with a ticker of CSH.UN. They are based out of Mississauga, Ontario, and they are one of Canada's largest owners and operators of senior living communities. They provide a range of services, including independent living, assisted living, and long-term care for seniors. Their current price comes in at $14.58. They've got a pretty big market cap, $3.98 billion. Their beta pretty close to being average at 1.12. Their earnings per share, they're on the negative side, negative 0.17. I expect that to improve pretty quickly as we move deeper into rate cut territory. Their funds from operation coming in at 73 cents per share. Return on equity, well, it's going to be negative as well, negative 4.61%. But the return on assets have already moved into the positive at 1.57%. Their debt to equity ratio, 192.20%. Looking at their dividends, they have a yield of 4.198%. It's a monthly dividend of 5.1 cents per share. Payout ratio, it's a little wonky because of some of them negative numbers, so take it with a grain of salt. 791.75%. Oh boy. On their 3-year return on investment, that comes in at 13.46%. Add the dividends in, we get a total return of 27.75%. On their 1 year, that return on investment comes in at 41.83%. Add the dividends, total return 47.78%. On that year to date, their return on investment comes in at 25.04%. As we add in the dividends, we get a total return of 28.98%. With over 200 communities across Canada, Chartwell can expect to remain an attractive option for investors as, well, I said it before, that boomer demand keeps on rising. In our almost top spot at number 2, we have Northview Residential REIT with a ticker of NRR.UN. They are based out of Toronto, and they own and operate a portfolio of multi-family residential properties right across Canada. They primarily focus on secondary markets and small urban centers, providing affordable and quality rental housing. Their current price comes in at $17.29. They've got a market cap of $682.14 million. Their beta comes in at 0.84, so they are a little bit less volatile than the market average. Their earnings per share come in at 4.78, and funds from operation $1.67 a share. That return on equity coming in at 23.39%. Return on assets, 6.93%. Their debt to equity ratio, 172%. Switching to dividends, we get a yield of 6.326%, monthly dividend of 9.1 cents per share. They do not have a payout ratio listed. Not sure why, but yeah, it's a good old NA for that one. On their 3-year return on investment, that comes in at negative 41.53%. Total return after we add in the dividends, negative 29.28%. So they fell pretty hard, but that means they've got a lot of ground to make up coming back up. So let's see some better numbers here. In that 1 year return on investment, we got 33.51%. Add in the dividends, 41.24%. Pretty much out of the hole that they created already. Year to date, return on investment, 26.76%. Sprinkle in the dividends, we get a total return of 30.76%. This is a REIT poised for some solid growth. With higher yields and the continuing rate cuts, we're only going to make their story better as we navigate deeper into recovery. In our top spot at number 1, we have Sienna Senior Living Incorporated with a ticker of SIA. They are based out of Markham, Ontario, and they are a leading provider of senior care and long-term services in Canada. The company operates retirement residence, long care homes, and provides specialized services such as memory care and rehabilitation. Sienna focuses on offering a continuum of care for seniors, catering to a range of needs from independent living to more intensive care. At the time of recording, their price comes in at $15.25. We get a market cap of $1.11 billion. Their beta pretty close to the average, 1.19. Earnings per share, 0.39, and they have funds from operation of 36 cents per share. That return on equity, that's coming in at 7.45%, and their return on assets, 3.58%. Debt to equity ratio, 275.10%. Switching to dividends, on their yield, they have a yield of 6.138%, a monthly dividend of 7.8 cents per share. Payout ratio on that, 240%. It's high, but once again, as we get deeper into rate cuts, we're going to see numbers like this starting to come down, and things are going to get back into a much nicer territory. On their 3-year return on investment, negative 4.21%. Add in the dividends, we get a total return of 13.43%. On the 1-year return on investment, 31.24%. Total return of 39.29%. Year to date, return on investment, 33.19%. Sprinkle those dividends in once again. We get a total return of 39.32%. I may be sounding like a broken record as I stress the opportunity in the senior care sector thanks to the aging boomers. However, we have seen a lot of proof of this today. The majority of the stocks in this list are in that niche, so it will definitely be one to watch for sure. I am very much looking forward to seeing REITs return to the conversation again. And I think these are some fantastic options, and we will see more as the rate cuts continue. It's going to be an exciting time to invest in REITs again. If you are interested in any of these real estate stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Brookfield Corporation, and I will see you in the next video. Boy, I'm a sweat soup. Hey. The video is over. Why are you still here? Can you believe I made a video about REITs without bringing up RMAX? See you next time, folks.